thank you guys for showing up to the last and arguably the best panel of the day. Bear with me as I just left another panel, and hopefully we'll moderate this effectively for a good conversation. But we're going to be talking today about the technologies insuring the uninsurable risks, right? And really looking at really very, very innovative and new solutions, as our panelists have already entered into the market and future state as to what the world looks like and the implications for insurance. So, with that said, I'm Steve Schwartz, Vice President of Insurance Strategy and Underwriting at Safe Security. Won't go too deep into Safe Security other than, as it applies to this conversation, quantifying cyber risk so that we can underwrite it more effectively and have a sustainable cyber insurance industry. But let me hand it off to my panelists to give some introductions.
Everybody, I'm David Fontaine, CEO and co-founder of Foresight Commercial Insurance. We're an InsurTech MGU that focuses on workers' compensation insurance for core industries across the country. So construction, manufacturing, agriculture, a lot of businesses in those categories that traditionally can struggle to place coverage just based on their loss history. So we've got technology and data that we bring to the table that allows us to examine their risk profiles and potentially give these people solutions that aren't a market of last resort. So that's how we're relevant to the topic today.
Hey everyone, I'm Ehab Ijaz. I'm co-founder and CEO of Breach Insurance. We are a regulated crypto insurer, and our first product is protecting users of popular crypto exchanges from hacks.
Hi everyone, Amit Arora, Vice President, Cyber Risk Solutions. I manage product development, innovation within this group at Swisri. I'm glad to be here and look forward to a good discussion today.
So a question for all the panelists here to get us kicked off. Why are uninsurable risks, as we've deemed them to be uninsurable, why are they uninsurable, right? As they exist today without new solutions, like the ones you've brought to market?
Our space is not because of the category, it's more of the loss history. And basically there's limited markets for the businesses that we look at. And quite often if they've had a series of adverse events, they might find themselves in a position where no private insurer is willing to issue them a quote, and they're forced into a state fund or a market of last resort, which is why they exist. But
yeah, I think to build on that, I think sometimes the market for the insurance solution may not be proven yet. So data on that. The other is you need a requisite amount of insurance experience dedicated to that uninsurable risk, and I think at times the risk transfer entities, whether they're a primary insurer or reinsurer, isn't quite in a situation to invest in those resources, people or capital. So,
yeah, I think in my area, we look at cyber risk insurance. The fundamental requirement is to conduct a comprehensive cyber risk assessment for the incoming policyholder. To be able to issue the right policy for them. When it comes to large enterprises, it's relatively easier to kind of look at their security posture, look at their cloud environment, look at what services have they subscribed to on the infrastructure side. But when it comes to the SMEs, micro SMEs and non-micro SMEs, I think that's where the typical challenge lies, because it's kind of difficult, relatively speaking, to understand what their risk posture looks like from a security perspective. A lot of them are still on-prem, haven't fully migrated to the cloud. So there is a level of opaqueness in terms of how do you even conduct some kind of a risk assessment for them. So I think for us, that's probably a big sector where a lot of uninsured potential clients live in.
So we have three different perspectives, and certainly, addressing different risks, right? How from your experiences, how do you each get comfortable with the risk, right? From a modeling, from a technical perspective, and when you do get to that degree of comfort, right? How do you go about driving the right awareness, education, and engagement with the insurance industry to actually bring that solution to market, or just get the right players involved in the conversation?
For us, we have a technology that we developed that allows us to collect proprietary data points on the levels of compliance and safety engagement for these companies that are in agriculture, construction, and manufacturing. So it's getting a really intimate understanding of what's happening on the ground level in a business, because businesses change, they morph, they evolve, and when you look at a snapshot of loss history from a business of two or 3 years prior, it might not tell the same story as looking at the business today on a granular level. So we collect external data, we collect all the data that you'd expect a traditional underwriter to collect, plus we have proprietary data we have access to create a much more comprehensive risk profile that's really down to the minute in terms of what's happening in that business. And that allows us to paint a different picture, I would say, to a traditional means of underwriting, which in certain light can be very attractive and can actually, we can see a path to profitability, and we know that we can help a business that may have traditionally have a risk profile that most people won't want to look at. So that's how we that's how we approach it.
Now, and with Flood Flash, like how did you guys start to explore the notion of a parametric trigger, right, and then drive that right awareness to the industry and ultimately to the end customers, right, who are receiving a different benefit from the traditional indemnity-based policies? We had been about 5 years of data collected that we were able to engage a bunch of independent actuaries, prove out a bunch of studies that there was actual substance to our methodology. And then with that, we were able to obviously garner the support of reinsurers and other carriers to come on board. So it really was a lot of, it was fairly arduous. It was a lot of collection and like a lot of time and just being able to prove that. And but once we had the methodology there, it was really just getting the right stakeholders on board that believed in it as well and could see the proof. Got it.
Parametric data.
Now, on a much different side, on the crypto side, if you will, right? How did you guys get comfortable with the risk, right, and choosing, which exchanges, which coins, wallets, et cetera, to cover, and ultimately go about that process of becoming a regulated, right, insurer to just differentiate against some of the other, crypto coverage, insurance providers out there, but also, the positioning for where the world is headed, whether it's NFTs, whether we forget about the 3-letter NFT buzzword, and it's just, the foundation of digital assets going forward. There's no question we're continuing to shift into an intangible world.
It's a good question. We get it from investors, from carrier partners, as well as from insurers. Like how do you insure something that sounds so catastrophic? And I think it really starts with deeply understanding the risk. I don't think it's something that you can just pick up and start to insure. I think it's something that you have to really build data on and really test pricing for it and how it models and stress it to various different scenarios. And I think it extends into traditional lines, insuring within crypto. It extends into what the future of crypto might be, whether it's DeFi or NFT or living in a virtual world. But I think it's really deeply understanding the space and spending a lot of time exclusively, building a thesis on what is actually insurable. And sometimes taking that experience and ignoring certain things and not focusing on maybe NFTs today, because it's a novel thing today, but it might become something that's insurable in 2 or 3 or 4 years. But I think it's really deeply understanding it and building some data and some theses around it.
Right, and that's where, right, I think having the right ecosystem of partners, technically, insurance side, that whole ecosystem, right, needs to come together. And, especially, and I mean, maybe we could start with you. Like, I understand the struggles on, underwriting small business cyber, right? How do we how much of that is an awareness issue versus a capability issue, from the insurance industry side? How do we get the trust of the SME to actually engage in the services we want them to engage, to help them be a better risk and, reduce their premiums, enhance coverage? Any perspective that you have in that regard?
Yeah, I think we have to bring people along. I think it's inclusive of regulators as well as insurers and reinsurers, and a lot of education for insureds as well. Crypto is so new for us, and what is insurance? Like, what aspects are you covering? How does it compare to a decentralized version of an alternative to insurance? I think it's spending a lot of time and really being clear on the kind of solution we offer and what we clearly do not offer. And I think that's an important thing. And I think it takes a lot of time. It really does. It's not something that can be built overnight. We don't want to be a flash in the pan. So I think we're taking the time to invest in, bringing regulators and insurers and insureds along for the ride.
Amit, I'd love your perspective on this, right? Coming from Swiss Re, I think everybody here knows who Swiss Re is and then the role that they play in the insurance value chain, right? What do you see from your perspective in terms of, right, just how do we actually engage these small businesses from a cyber insurance perspective, right? Whether it's utilization of certain tools or, since you're most often, a degree or two or three degrees, removed from the end customer. What are you guys looking at the reinsurance level when it comes to emerging risks and how to bring together new solutions for the end customer?
Yeah, I mean, look, SME market offers a great potential in terms of growth for this sector. So it's relevant and top of the mind for Swiss Re and other companies like us to kind of look at this opportunity and figure out, how do we crack this nut, right? And I think if you look at the behavior, right, SME versus non-SME, what really drives a small company to even subscribe to a cyber risk insurance policy, right? Most of the times it's
Contractual.
A large contract point in time that they are entering with, like, a big customer, etc. And because of the contractual requirements, they are supposed to have a cyber risk liability cover, right, to protect the customer's assets. If that opportunity or if that moment did not exist, we believe there's only a very small portion of the SME market who would actually buy a cyber risk insurance policy, just to kind of protect their own assets. Because to your point, it's an awareness issue. Absolutely, right? Small companies do not understand cyber risk, first of all. So constant education and training and awareness creation is a must for that sector. But in terms of an opportunity, I think that's where the untapped market really is. And providing simple tools and simple solutions that do not require a lot of cycles to be burned in terms of telling them this is how you can measure your or assess your risk posture, security posture of your environment, getting them to a quantifiable output of what that looks like, and then marrying that output to some kind of a premium pricing model, is one of the simpler ways to kind of create a customer journey that small companies can understand. And look, small companies do not have, designated CISOs and, governance frameworks and, robust policies and procedures in place like the big companies do. So the product has to be different in that regard as compared to a cyber risk solution product that can be offered to bigger companies. So I think that's a bit of a challenge, but an opportunity as well for us to kind of really discover, figure out, validate what the right consumer experience should be, so that it's easier for them to also pay for a cyber risk insurance policy irrespective of whether they are, signing a big deal with somebody else, that kind of triggers it. So we are trying to look at it from a deal agnostic perspective as well.
When you bring up a good point, right? How does distribution factor into all of this, right? Like Flood Flash, are you predominantly broker-led distribution versus breach insured, direct to consumer, right? Just how are you guys seeing this trend shape in terms of your adoption? And just I can certainly, to Amit's point, on the SME cyber side, there's so much awareness even for the brokers. The majority of brokers, a lot of them don't want to talk about cyber, right, or get into IT because that's not their domain expertise, and I don't blame them, right? But I think it's important that we keep that, obviously we keep distribution in mind if we want to have a successful product. But yeah, curious on what your guys' perspectives are and how you thought through, right, how to affect, what distribution channels to prioritize over others.
We were acting as a broker for a number of years to solve this problem. So we had a small agency in San Francisco, and we were brokering for about, let's say, close to 36 months. And that was for us, it was more of a sandbox. We didn't want to become a brokerage. We basically just wanted to understand how workers' comp was distributed to these industries that we were targeting, and we could see the need. There was a need there. There was a shortage of markets. And we really learned a lot in that time. Mainly that for us, that discovery was that most incumbents aren't offering technology. They're not using a lot of external data points to price risk and to assess it. And there was just a huge opportunity for us to work with in the broker community to offer a new product line and a new way of looking at these risks that we considered underserved. Mm-hmm. So for us, it was the distribution strategy hasn't really been a challenge because we put that time in and really shaped the product. And brokers are just very, we're dealing with, for us, I'd say there's a shortage of markets for the lines that we're looking at. So it's been really easy to get distribution because the brokers are kind of starved for this, these kind of innovation products in these traditional spaces that haven't, like if you take a line like workers' compensation, hasn't really changed in probably 50 years. Like,
not many people want to underwrite commercial trucking.
Yeah, exactly. No one wants to do trucking or roofing, but which we do roofing. But so yeah, it was distribution for us was really just about figuring out what was out there, figuring out what was being offered, and then really nailing it, which we think we've done. So.
And the co-creation, right, in that process, which led to said product. But I'm sure, like now from your perspective, right, correct me if I'm wrong, but predominantly direct to consumer?
Actually, so although our product is available D2C, the distribution channels that we're really leaning into are partner distribution. So There's a number of national and regional brokers that are getting appointed, and we're in a number of conversations with insurance companies. Also, like get the product distributed through insurance companies as well. So it's been it's been interesting to see how many brokers have come to us seeing the demand that they see from their insureds as an interesting conversation. It's a sticky thing when you have a new product. It gives them something to talk about. So broker and insurer distribution is an important, I think, part of our story.
Could you embed your product? Have you?
Yeah.
Is that your main source of distribution?
That I do see that. I do see that as a major scaling opportunity for us, and that's something that we've been talking to.
Right from the exchange or wallet.
That absolutely. Mm-hmm. Yeah, those conversations with exchanges, wallets, custodians, all of that.
Mm-hmm. I think a lot of people often forget that without insurance, the world stops. Right? We're not at this conference. We're not able to drive our cars. We don't have the businesses we have. Right. And, my question, I'd like to start with Amit and work down the line. As we continue to shift into this intangible world, right, with new emerging threats, new risks, you look at DE&I, which is an emerging risk, which, can be quantified to a degree, certainly when you look at EPLI and, the not unemployment, but just sexual harassment lawsuits, et cetera. But Is it going to go as low as Terra?
Someone wants to make some money.
But is the insurance industry innovating fast enough to keep up with the changing risk, landscape, if you will?
I don't think so, to be honest, right? When you look at the cyber risk area, right? There are new threats evolving every day, right? World over, right? And it's mostly a reactive approach. So I think you start with phase one, what we call cyber coverage, adequate cyber coverage, right? All the way to, continuous cyber risk quantification, right? That's the holy grail of where you can be, right? And how do you get there is the big question, right? There are different ways to kind of get there. For that, you need continuous data stream of client's environment, what their security posture is. And look, policies are written once a year, premiums are paid once a year typically, right? When it comes to cyber policies, right? You write a policy today, tomorrow, some world event happens, log4j and whatever, have you. What do? Do you go back to the customer and say, I want to bump up the premium 3x? Doesn't happen like that, right? But if you look at the same use case in the motor insurance, for example, you have telematics, you have pay as you drive, pay how you drive products that are also continuous monitoring of driving behavior for a policyholder at the retail side. That's something that's already happened in the industry. So if you were to kind of take that analogy, apply it to cyber risk quantification, right, and figure out how can you collect data for an enterprise on a continuous level and a continuous basis, and apply that data stream back to risk quantification, and then have that linked to your pricing models. So the pricing models kind of tell you whether the premium is going to go up or down based on the ever-changing risk profile. I think that's the holy grail, and I think the secret or the big challenge to that is operationalizing that cycle. There are multiple ways to do it. There are a lot of companies who are thinking about it. Swiss Re is one of them, and we are looking at different approaches in terms of how we can make that happen as well. So I think once we crack that, that's the next frontier of cyber risk assessment and controls.
I think you're reading my mind. In that regard. So as we move down the line, not going to get into the Bitcoin question, but where is the price of Terra Luna headed? But yeah, what are your guys' perspective, and what are you doing to stay ahead, right, of the industry, right, and keep up with the emerging trends and just where the world is shifting, into?
I think it's just continue to build out that risk profile in terms of collecting as many data points that are available publicly and building more granularity into the model, as well as increasing. We have a proprietary system that we implement called SafeInside that we will continue to invest in and build out as well. So, like, over time, we'll just have a lot more. We'd like to say real-time data, and our vision is real-time insurance for workers' compensation. So really decreasing that amount of time between when businesses get rated, essentially, or that rate's assigned. And we see that a key cornerstone in that ability is to collect data on a live cycle and have that data be really rich. And I think that's where, just in many lines of insurance, like auto, G&L, there's heaps of companies, there's heaps of technology companies out there that are thinking about it the same way in terms of looking to leverage real-time data to improve the risk modeling and potentially, insure the uninsured. Mm-hmm. So,
right. And is there a degree of services that goes along same, regardless of the line of cover that we're talking to? And I guess we'll pick up one of the last questions here. In what ways do you see crypto and blockchain being used throughout the insurance industry outside of crypto theft coverage?
We're not using blockchain, for example. I think where we are in the sense of operational efficiencies, but it's a really interesting. I mean, the type of coverage that we offer and the type of risks that we insure. It's really interesting because, Jim and I, our head of risk and chief actuary, were talking about this morning, but, insurance companies and investors ask us about the risk of fraud, right? And, what if there's fraud? What if somebody claims that something happened? And you better be like Satoshi and not touch that crypto, because eventually, if you do touch it, then you've exposed yourself as committing insurance fraud, right? So it's just an interesting dynamic. But I'll go back to your other question as well, as like how we're staying ahead of the curve. I think in crypto, staying current is more important than staying, because candidly, the industry has a new technology, a new flavor, a new something, a new risk on a monthly basis. And I think that is also what has I think
Mm-hmm.
prevented legacy insurers and reinsurers to really get comfortable with it, because it's you need to have spent
So dynamic.
an incredible amount of time to understand it, to get comfortable with it. And I think once you start to do that, then it starts to look less scary. But I think it's really staying current, which is the most important thing within crypto, because it's people are unforgiving in crypto. I mean, there's if you have a shitty product, they will call it a shitty product. So it's been an interesting kind of experience overall for us.
Now, have you seen any, to a degree, some crypto theft, crime insurance for, say, a trader trying to capture arbitrage across 18 different exchanges?
They ask. Yeah,
I know.
I mean, they ask. It's like, do you, and, something that we were seeing really recently was, Coinbase had to file something with the SEC around, the risk of bankruptcy and what would happen to assets. And, we're getting a number of questions like, do you protect against bankruptcy? It's like, no, we kind of don't do that. But, we should think about it. But, it's one of those, we get different questions, on a daily basis.
No, all fascinating. I think we could dive, much deeper into each different lane here. I want to be conscious of time, and looks like our questions are already wrapped up. So time was conscious of us, but we have a question.
And I'm from the Bronx, so I talk pretty loud. So if there was a secondary market, where investors were able to actually buy and sell in a liquid market insurance or reinsurance contracts, so there would be price discovery rather than an annual contract. Okay, we made a reinsurance deal for the year, but where there was a secondary market to actually trade risks, would that be helpful in terms of being able to insure the uninsurable?
Separate from the ILS market?
Yeah, definitely separate from ILS is very constrained, but
yeah, I mean, I think so, right? Insurance, and we'll pass this along, but at the end of the day, insurance starts as a blank contract, right? And you can manuscript the wording from start to finish. If you have a collective of whether it's private equity funds, reinsurers, whomever it may be, aligning around a risk, I would question as to why couldn't we insure that, or maybe approach a community almost like a mutual if there's some peer-to-peer component to it. I don't know what the group thinks.
I agree with that. Yeah.
you'd like to see a market like that?
I think it kind of it's sort of already happening when you think about the way that when you're dealing with reinsurance, and like they quite often bundle the same risk categories together and on-sell that risk. Like we can sell the tail in our business similar to, it's just not on an individualized contract level of the per policy level.
Right, but once you've signed that treaty, and it's done, you don't know what it's worth the next day, do you? And I'm talking about totally self-serving, forgive me, but you know what? That's why I'm here. So I'm a partner in a company called Extraordinary Re. Some of you may know of us, and hopefully a lot of you will. We've actually created the first and only secondary trading platform for reinsurance contracts. Mm-hmm. We've built the system. It's ready to go with NASDAQ technology that we've used. We have the regulatory infrastructure that makes it kosher, and where we think it's the next great thing, the natural evolution of ILS. ILS, great, 80 billion, whatever, pales by comparison to the 20 plus trillion of liabilities on the books of insurance and reinsurance companies worldwide. So that's why I go back to a liquid market where you have price discovery. What is my contract worth tomorrow? Not today, the day I signed it, but where you could have institutional investors that want non-correlated returns to be able to get into this market. That's what I'm talking about.
Yeah, I think as long as you have the appropriate data and the market itself, right? The demand.
Yeah, the market would have to be somewhat educated, right? Like, because I mean, every person knows about stocks, and some people know about options and crypto, but it's like a whole nother world. It's a whole nother commodity to get your head around.
Insurance is hard to read about in a book. ILS is a whole
thrilling stuff. People love learning about insurance too, as we all know. So,
to bring it back to crypto, I mean, this is what like DeFi has kind of done, right? Where they've created this supplier from non-capital markets type of funding to insurance risks to lending to whatever, and then being able to earn and take part in profit sharing or interest earning or whatnot. So kind of sounds like that, but it seems like a kind of like a hybrid between that, because that's the extreme, because that's like completely unregulated.
Yeah.
And then you've
Hope
got
it's not
something
a rug
that's a
pull.
security with an ILS. So yeah, I mean, I wouldn't see why not. I mean, if you're solving for a problem, then I would imagine that you'd have demand for that.
I think I'll probably share my comments offline with you if that's okay.
But I do
He
remember
wants to
connecting with
invest.
Will Dove on this a couple of years ago. So it is a fascinating topic. But yeah, so thank you guys for joining us for the last session of the day. Hopefully we didn't hold you up from getting some drinks and enjoying the rest of the night. And thanks to all my panelists here.
Thank you.